Anand Tandon joins in to give us his views on the markets and individual sectors as well. Anand, hi, morning. Thanks so much for joining in. We've been in a bit of a good place, at least in the last 2 or 3 trading sessions. Do you think the worst in terms of the selling pressure is done for now?
Depends on your time frame. I think, we've already had too fast a bounce back, just like we had a fast collapse. I just heard one of the other members on your team right now saying that, I would be looking to sell off anywhere from here to 5,300, and I would concur with that absolutely. I think, we've already reached the stage where the fundamentals would justify the market to be, and given the kind of volatility and more importantly the kind of uncertain macroeconomics that we are going through globally, it is highly unlikely that the market should sustain higher than that.
Hi Anand, morning. Just because of the sheer depth of the fall though, would you say the market has more in this bounce back rally, or this is about it?
Well, as I said, you could get a couple of 100 points more on the Nifty. That is entirely possible. If you remember, I had actually for the last couple of times on your show been saying that anything below 4,800 is a reasonable place to buy. But also the fact is that you should be looking at least 5 to 6 months of hanging around in that area. Obviously the market doesn't stop at one point, so you should get movement around that couple of 100 points up and down from there, and that's pretty much where I see it going. I do not see a directional pull up beyond this in any sustained manner, nor do I, though there is a reasonable probability that you might actually get a fall back of the same kind of amount below the previous low.
What's the linchpin event here, Anand? Is it global markets and for them to affect some kind of a bounce back rally, or does it remain a domestic cue, perhaps the RBI and what it decides to do?
A bit of both. There is no question that the global issues remain dominant, and therefore the fund flows will depend on that. And by no means are we out of the woods yet in any form or shape. On the domestic side too, I have been hearing a lot of comments being made that we are at or at the top of the interest rate cycle and so on, and that perhaps RBI should ease off. My argument is that I have seen nothing in the data that tells me that you should be looking at easing off. If you look at the so-called slower GDP growth that we are witnessing, most of it is coming because of lower investments, and investments are not happening not because there is lack of demand. If you look at the consumption side of the story, it continues to be very strong. The clear reason for a fall seems to be more the fact that there's been huge expansion in capacity in most industries over the last 2 or 3 years, and of course there is therefore that has to be kind of walked through the system. So I don't see any particular industry which seems to be in terms of a shortage in terms of capacity. So the investment demand is falling off in my view cyclically, besides of course the fact that the government is not creating enough policy action to encourage investments in areas like infrastructure where you could have.
And how would you start approaching this bounce back rally, even if it is a tactical call? What is it that you would look to buy in order to get some kind of upside potential going?
It depends on the time frame. Unless you have a 2 to 3 year time frame, I don't think you should be looking to get in. However, every time it falls, you may want to look to buy, and there I would argue that the best and safest way of playing the market is to buy the Nifty. The volatility in individual sectors and stocks is now very high simply because there is lack of direction, and more importantly, there is just too much of government activity that is happening, which is difficult to predict whether it is policy or whether it is regulatory in nature. So for most sectors, you find that the ones that are actually moving up and down are really those where there is a lot of government action that's happening. On the purely economic parameters, there isn't that much that you could argue that is going on. I would actually recommend that one is somewhat underweight banks in spite of the fall, because though they will come back a bit, I'm arguing that we are in a stage where globally and as well as in India, you will have to have greater regulatory oversight on banks, and therefore that may reduce the attractiveness of the companies. We've already seen that happening in the NBFCs. So that's the largest sector in the market which you have to come down on, which essentially means that if you really have to take a bet in terms of growth, you have to look at the beaten down sectors. And I've been saying that things like like construction, for example, is the one long-term story which to me looks now reasonably priced, provided you can pick up those which are not going to go bankrupt in this fall.
A couple of other stocks in the broader markets that have started to correct on relatively higher volumes. EduComp is down almost about 3.5%, so that one is down and out. IDBI Bank is showing you a cut of 3.5%, and like Anand was pointing out, many of these potential aspirants for banking license have corrected quite a bit post that news coming in and that rally. So L&T Finance should also be up for you. It's up down another 1.5% or so. Anand, you were talking about the pull up for the market and the resistance, but what about the support? What is the probability, or how high is the probability rather, that the market would tread below that 4800 level because of the situation that we are in, where globally things are not looking so good?
I think there are two contradictory forces working here. On the one hand, my argument is and continues to be that I think euro is under serious stress, and at some stage in the next 12 to 18 months or maybe even earlier, you may find that the currency actually gets split up into multiple currencies. I do not see anything happening in the various government pronouncements that have been made across Europe which has any which holds out any hope that any policy action that they will come out with will actually satisfy the market and prevent the breakup of euro. So that's a major risk that you are looking at. On the other side of the market, of course, is the fact that there is also a danger that QE3 will start, and willy-nilly the US may be forced to print out more money, and will be followed by some of the other countries in Europe. If that happens, then again I think you'll have a rush of money coming into emerging markets like India, and given that we are one of the worst performing markets for the year so far, that may actually lift up asset prices and bring back fears of inflation. Logically, at that time, the Reserve Bank and the government should actually put quantitative restrictions on money flows coming to the country. But if that were not to happen, you would find that asset prices, including stocks, may actually go up. Your guess is as good as mine as to which one of them is more likely to happen and which is likely to happen first. But I would say that the probability of a downside is not insignificant.